In this video, we'll discuss 3 ways that companies can trick their investors. And if you've been following this channel, you'll know that I started out my career at PricewaterhouseCoopers as an auditor. And so the topic of fraud and checking financial statements is something that's right up my alley. And in my past videos, I've discussed many of the important fraud cases such as Enron, WorldCom, Waste Management, and Tyco. But basically all of these cases, we've discussed them after they become headline news. But I've gotten so many requests from you guys to create videos on how to detect for corporate fraud before it becomes front page news. And basically I'm making this video to give you some of the tips from my experience as an auditor for the things you should be looking for when you're looking at a company's financial statements. And so the way I want to structure this video is I'm going to give you the 3 common ways that companies can trick their investors. And I'm going to give you an example for each one of them so you can understand it. And then by the end of the video, I'm going to give you the ways that you can find out about this fraud yourself and basically what questions you should be asking yourself and the company when you're looking at a set of financial statements. And without further ado, let's dive into today's video. Make sure to download our balance sheet metrics cheat sheet. It's 100% free and an amazing resource, especially if you're a financial professional, finance student, or into stock investing. I'll leave a link in the description, so go ahead and check it out. And again, it's 100% free. Okay, so trick number 1 is when a company understates its bad debt expense. And basically, bad debt expense is a cost that goes on a P&L to recognize that some of its customers, some of the company's customers, won't pay what they owe the company. And so basically, the company shouldn't be waiting up until the point where the customer fails to make payment, but rather the company should periodically be accruing for the bad debt expense by creating an allowance for bad debt expense. And to drive this point home and to make it clear, let's go through an example of what the company should be doing to accrue or to make an allowance for bad debt expense. Basically, the company should be looking at an aging schedule of its receivable. And as you can see here, the aging schedule will show the customer name, what they owe in the current column, and what's in the current column basically is what's within the pay period or the payment period that you allow on the invoice. If it's 30 days, that means that for customer number 1, this amount is current or within the payment window. And then past due, in the past due columns, you'll see 1 to 30 days, 31 to 60 days, and so on, all the way up to 91 plus days of past due invoices. And basically what the company should be doing is should be assigning a percentage of probability to each of these buckets based on its historical collectability. So basically, it should be looking at the current column and saying, okay, based on history, we haven't collected 1% of these amounts. And so basically, it should be assigning 1% probability of not collecting current AR. And then for the past due, for each of these columns, the company should be assigning a percentage of likelihood of collectability. And basically, for example here, 1 to 30 days, the company could be assigning 2%. And then from 31 to 60 days, the company could be assigning 3% and so on until it reaches 91 days, 91 plus days, that could be 5% of uncollectible AR. And basically, as you can see, the longer time it takes for the accounts receivable to be received, you are increasing the probability of it not being collected. And basically what the company should be doing is gathering up these amounts, once multiplying these percentages by the totals at the bottom here. If the company arrives at a total probability of uncollectible AR of $20,000, let's assume in this case, then the company should be recording a journal entry at period end that is debit to bad debt expense and credit to allowance for doubtful accounts. And so the 2 common ways that companies can trick their investors in this step here is that they can either not record the allowance altogether and just wait around to see which customer is not going to pay their invoices and record that as bad debt expense. Or another way to do it too, to trick the investors, is to reduce the percentage of probability of not collecting AR. Basically, for example here, for 91 plus days, instead of recognizing 5% of probability not being collected, they make that 1 or 2%, and therefore that would reduce the amount of bad debt expense they are recognizing on the books. Okay, trick number 2 in today's list is when a company recognizes revenue from a long-term contract too soon. And to make this point clear and to illustrate, let me give you an example of what I mean here. Let's say that a company enters a contract with a customer and the value of the contract is $300,000 and it covers a period of 3 years based on a certain deliverable. So let's say this is legal services and the company should deliver services over 3 years. What the company should be doing in this case is that it should be recognizing the revenue over the life of the contract based on the delivery of the service. So basically, in this example here, let's assume that the company delivers the service on equal basis for year 1, 2, and 3. It should be recognizing 100,000 in year 1, 100,000 in year 2, and then 100,000 in year 3. And what I've seen happen in some cases is that either the company in error would recognize the entire 300K upfront in year 1, or what I've seen also in some other cases is that the company will manipulate the contract itself and the language of the contract to make it so vague so that it allow the company to recognize all of it in 1 year, even though that if you look at the spirit of what the agreement is, what the service is, it's something that the company will deliver over time longer than 1 year. So basically that's trick number 2 that a company could use sometimes to trick investors. All right, trick number 3 is when a company capitalizes its operating expenses. And basically, as the name implies, operating expense. An operating expense is something that's needed to operate the business, and the company should be recording it on the P&L. But we've seen in some cases the company would take that expense or cost and capitalize it as an asset and then amortize over a longer period of time. And the famous example is WorldCom. I'm going to leave a link up here to the WorldCom case that I've covered in the past. But basically what WorldCom did is that when they paid rent for the phone towers that were needed to service their customers, basically they treated the payments on the rent as an asset that will benefit future years rather than an operating cost in the period. And basically that was part of the fraud. And so this is a very common way for a company to cook its books and trick their investors. And in the coming minutes, I'm going to give you some ways on how to find and check for this type of fraud. And as I said, I'm going to give you some ways you can be checking for these types of fraud if you're suspicious that any of these types of fraud is at play. Basically, if you're suspicious that the company is understating its bad debt expense, you should be doing 3 things. Number 1, you should be asking the company whether it accrues for allowance for bad debt expense. So that's the first thing you should be doing. You should be asking the question. Secondly, you should be asking for a bad debt policy. And every company basically should have a bad debt policy, which is usually 1 or 2 page policy that describes the steps and the procedures that the company takes to accrue for bad debt expense. And then third, you should be looking in the balance sheet to make sure that there's a line item for allowance for bad debt expense. And as for the revenue recognition, if you're suspicious at all that the company is recognizing revenue that it shouldn't be recognizing, you should be doing 2 things. Number 1, you should be asking the company whether there has been any anomaly in revenue recognition in the period. Basically, asking the question is a way for you to just gather information so that the company can tell you if there's anything out of the norm about the revenue in the period. And then second, you should be asking for a revenue by customer list. So basically, you want to look at the revenue detail by customer. And then when you look at it by customer, you should be comparing period over period and looking for hills and valleys. Basically, you're looking for any dips or any spikes. And basically, that will give you some idea on what to ask for. So if you see one of the customers, for example, having a big spike in one of the months or one of the years, you should be asking the question to find out, to get more information, why the spike or why the dip for this customer. And the question will then prompt the company to give you some more information on the matter, and that will help you spot if there's any issues with the revenue recognition. And for the third item, if you're suspecting that the company is capitalizing any of its operating costs, you should be doing a couple of things. Number 1, you should be asking the company whether it capitalized any costs in the period. And basically that will give you some idea right off the gate whether the company has capitalized any of its operating costs. And then secondly, you should be looking at the balance sheet and looking at every item in the balance sheet and asking for a breakdown of the balance, what you see in the balance sheet. Because basically then, when you look at the breakdown of the line item in the balance sheet and the support for these items, then you can spot if any of these is an inappropriate capitalization of operating expenses. All right, that's it for this video. If you liked it, give it a thumbs up. If you haven't subscribed, go ahead and subscribe to the channel. If you have any question on any of this stuff, go ahead and leave me a question in the comment section below, and I'll see you in the next video.